The charitable remainder trust is a very valuable tool for deferring tax in liquidity events. But there's a looming issue under the surface that a lot of people don't recognize or realize, and that is the exposure of the trust to unrelated business income tax, or UBIT. And care must be taken to limit or eliminate the trust's exposure to UBIT to fully maximize the tax deferral opportunity. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode 235, we're going to look at charitable remainder trusts and unrelated business income tax, or UBIT, and how that can apply to the trust and cause some unforeseen headaches. As always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. A little bit about me: I enjoy doing what I do because I love speaking and teaching. So, if you'd like an in-person or virtual speaker for your upcoming event or your firm or organization, please email me at griffin.bridgers@gmail.com. If you enjoy this presentation or my other material, and you'd like to subscribe to my newsletter to get more exclusive content, please visit griffinbridgers.substack.com. Now on to the presentation. So I've long had it on my plate to continue the common estate planning trust series and jump into charitable remainder trusts. The problem is charitable remainder trusts aren't quite as common in estate planning, so it's a little bit of a misnomer to use common estate planning trusts in connection with this type of trust. But either way, the mechanics of this I'm going to save for a later presentation, but generally a charitable remainder trust creates a current income interest, which is usually payable to a non-charitable beneficiary like the grantor or the grantor's spouse usually, and then a remainder interest, which after a term of years not to exceed 20 years, or after the lifetime or joint lives of the grantor or grantor's spouse, will pay the remainder over to one or more charitable organizations that are identified under the trust instrument or appointed by the income beneficiary. Now, mechanics aside, one of the biggest benefits of a charitable remainder trust is tax deferral, because the trust itself is tax exempt and is not taxed as a grantor trust. So the idea is that an illiquid asset could be contributed to the charitable remainder trust by the grantor, potentially at low or no gift tax cost. Then the asset would later be sold by the trust itself. And on that sale, the trust would not recognize any gain because the trust is a tax-exempt entity. However, any deferred income and gain, it's not tax-exempt forever. It's only tax-exempt with respect to the trust itself. It's accounted for and held in abeyance on IRS Form 5227 every single year. And ultimately, that deferred income and gain will be taxed on ultimate distribution to the non-charitable beneficiary, who, as I mentioned, is usually the grantor or the grantor's spouse. And that distribution would typically be in the form of an annuity or a unitrust, which I'll discuss at a later time as well. Now, even though the trust is technically tax exempt, that tax exemption has a limitation. And that limitation looks at whether the trust itself earns any unrelated business taxable income. If it does, then there is an excise tax, which is equal to 100% of that unrelated business taxable income, which seems pretty steep and can really cause headaches for the trust itself. And what that means is that if the trust or a pass-through entity owned by the trust carries on an active trade or business, and the purpose of that trade or business is unrelated to the charitable purpose of the trust, which is typically going to be the case, then the trust will pay an excise tax that's equal to all of the unrelated business income earned by the trust or passed through to the trust from a pass-through entity. Now, we're not going to dive into the semantics of this definition because I can't do it justice on this screen. What's helpful is to kind of know the general exceptions. And the general exceptions look to passive income. So things like dividends, rents, royalties, interest, and capital gains wouldn't really be treated as unrelated business taxable income, unless in some cases you can show that debt finances that passive income. And that's its own nuance in addition to some other nuances that we just don't have time to dive into today in the context of what we're talking about, which is how this tax relates to charitable remainder trusts. But either way, this can be very steep. So what it seems to make sense to do is to try to limit the trust's exposure to unrelated business income tax if possible. So we're going to look at avoidance and then reducing exposure. So as you saw in the last slide, if you want to avoid UBIT entirely, you have to look to what assets are being contributed to the charitable remainder trust. So if you're contributing C corporation stock, you should be safe because the only benefit that goes to the trust in that case is a dividend. And the way that the IRS sees it is, in this case, the C corporation is going to be paying income tax on that business income, so they're not as worried because they know that the return that goes to the charitable remainder trust is going to be passive income. However, if you don't have a C corporation, if you contribute a pass-through entity interest, such as a partnership or S corporation, this tax could be triggered, because you're really going to look through to determine the character of income in the hands of the charitable remainder trust. And the character of that income could include unrelated business taxable income. So sometimes what happens in this case for a general charitable foundation would be the use of a blocker corporation, which would then own the interest in the pass-through entity and block the charitable remainder trust from having any unrelated business taxable income. So what this does is it does result in a corporate level income tax if you have a domestic corporation, but the amount of tax there would be less than the amount of unrelated business income tax you have in play. Now, you could use an offshore corporation, which could be tax-free in certain circumstances, but that's going to open up its own can of worms elsewhere in terms of reporting and everything else, so it may not always be the best option either. But either way, you might want to look to whether you have a corporation to begin with, and if not, whether you could use a blocker corporation. Now, assuming that's not practical, what you might want to do is look to whether it's possible to limit the trust's exposure to UBIT. So what happens is maybe you limit the runway of time between when the assets are contributed to the charitable remainder trust and the time that the asset is sold by the charitable remainder trust, because the less exposure the trust has in terms of time or temporal exposure, I should say, to UBIT, then the less excise tax could be paid. But you have to be careful because this is a fine art. It's possible to be too late in your contribution to the charitable remainder trust. And if you are too late, then you can run into what's known as the constructive receipt doctrine. So in this case, what we have is that the IRS could step in and recharacterize the form of the transaction to say that all of the income from the sale and the gain is recognized by the grantor and not the charitable remainder trust. So the IRS would essentially reverse the steps. They treat the grantor as if they sold the asset to an outside third party and then contributed the cash proceeds to the charitable remainder trust. Now that seems bad, and it may not be as bad when you consider the potential income tax charitable deduction that you could get on the front end. But that deduction may be limited as well based on the size of the remainder interest that goes to charity. And most of the time, if you're doing this for tax deferral purposes, you're going to really be trying to squeeze as much or as close as you can get to that 10% remainder, which may limit your charitable deduction that you could get to offset that gain that would be deemed recognized by the grantor. So what do you do here? How can you get around this? Well, what the weight of authority looks at is whether the sale by the charitable remainder trust to a third party was binding at the time of the grantor's initial contribution to the charitable remainder trust. If it was binding at the time of the initial contribution, it's too late. And this is largely going to be dependent on state law and the terms of sale documents that have been in place and that may or may not be binding. So typically, a good rule of thumb, and this isn't a hard and fast rule, but is to look at if you have a purchase agreement signed and you're really just working towards closing, then it's too late. You have a binding agreement then typically, and you're not going to be able to contribute the asset to the charitable remainder trust at that time if you want to get the full effect of deferral and avoid UBIT issues. But if you have gotten just to the phase where there's a letter of intent or memorandum of understanding signed, you have to look to whether that letter of intent or memorandum is binding. If you can back out and it's not binding, you may be fine. But if it is binding, it may be too late at that point to make the contribution to the charitable remainder trust as well. But either way, you've got some exposure here at least between the contribution and the time of closing. So the shorter you can make that period of exposure, the lower the potential for unrelated business income tax. As always, if you have questions or topic suggestions, you can email me at griffin.bridgers@gmail.com. Please note that I cannot give tax or legal advice in response to your questions. But thank you again for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.